because I'm coloring this off, the buying power went from $2,300, which was already really, really good because the notional value is 32,000, a little over that. But when we color it off, look at this buying power that's required in this account. In your account, it might be less, it might be a little more than that, but it's still going to be very, very low amount based on what you are controlling. So what I want to explain is the MES futures contract first, and then I want to explain doing a collar strategy on it. So for everyone on the call that does not understand what is a futures contract, a futures contract is a way for people to bet on something in the future. So an easy way to explain it in most kind of textbooks kind of give you the kind of farmer type of scenario. The farmer has a crop of corn and it's not going to be harvested for, as I say, 2.5, 3 months down the road. And so to hedge that crop, right, because their crop is bullish, right? That's how they're going to get money. They're going to try to sell it for a certain price. So to hedge it, what they would do is go into the futures market and they will sell some futures contracts that represent a certain amount of hedge on their corn. And that's like a traditional way of using futures contracts. Years passed, and then they came up with kind of financial futures, like the S&P 500, which we are looking at here. And what's really popular is the E-minis, the ES, the /ES, and what is a lot newer is these micro E-minis. They try to make it smaller so people with a little less capital can still play the S&P 500 futures. So this is the micro futures, and we're not betting on or hedging some type of crop, but we're betting on the index going in a certain direction. If we were just outright buying the futures contract. So if you thought it was going to be higher in the future, you would buy this futures contract betting that it's going to be higher, and you will sell it once it does get to the point that you thought it was going to go. And vice versa. If you're a negative on the S&P 500, you can use this futures contract and it's going to give you leverage. The way it works is that you don't have to pay 6,400 for this index is going for 6,428, or you don't have to pay the denominator what it is. So with options on stock, the denominator is always $100 per point. When you're doing the /ES, it is half the size, so it's $50 a point. It's half the size of the SPX, so it's $50 a point. And the micros is 10 times smaller than the ES, so it's $5 a point. So if it goes up, let's say $10, then you're going to make $50 on the micros. That's what we're talking about here. And it's going to be what it's called mark to market. And so at the end of the day, it's going to show in your history that it's settled and you were up this $50. If tomorrow it goes down 10 points, then at the end of the day, mark to market, it's going to say that you're down 50. So when it's all said and after the 2 days, you're basically flat, okay? Not including fees and commissions. So you're it's like shares, this futures contract, and the way we do the collar, we consider this like shares, but it's not like shares because when you buy shares, you have to come up with the monies up initially to buy the shares. So if you're going to buy the S&P 500 SPY, it's going for over $600 a share. So that's $60,000+ you have to be able to trade that if you're not using margin. That's literally coming out of your cash. It's not that you lost or won yet, right? Because it has to go up or go down for you to lose or win. But when you're doing the futures contract, the only thing that's going to change is the fees and commissions initially, what you pay. So for example, if I jump over here and buy this futures contract, you'll see here that it's not asking for $60,000 or anything such as that. Only thing I need to have is these fees that it has, the fees of 67 cents, commissions of 75 cents, and then the buying power. This is how much I need to be able to put this trade on. Now, futures contracts have expiration dates. They usually expire when you're using the MES or the ES. They usually expire every 3 months or every quarter. but they do not have time decay. That's what differentiates futures contracts from futures options or any type of options. Options have time decay, meaning that if it does not move in either direction, it's still going to be losing value because of time decay, because it's always going to expire. Options, as you guys know, can expire today, tomorrow, or years from now, but it will expire. The futures contract would expire, but it does not have time decay. You're not going to lose any value because it's getting closer to expiration. You're going to have to move your futures contract to a new expiration period, but you're not losing any monies due to time decay. So, for simplicity purposes, I try to articulate that the futures contract for collar purposes is like having shares, but futures contracts is leverage. It's significant leverage. You don't have to use a lot of money to be able to control a very high notional value. Okay, a very high notional value. What I mean by that is that if you take this 64.29 and you times it by the denominator of $5 per point for this MES, that's going to tell you the notional value. So 64.29 times 5 is $32,145. That's how much this futures contract is worth, this micro one. It's worth over 32K. You're only having to put up $2,300 to be able to control this contract that's worth $32,000. Just want to take a quick second and say if you're interested in learning more, please consider joining our trading club. You can do so for a 90-day trial period for a flat $60. Check out the description below. Now back to the video. But when we collar it off, it's even better for us. And this is why I like members to use this as a collar, because it's following the market. This is the S&P 500. If the market's going up, this is going up. If the market's going down, this is going down. So if we collar this off, let's just say, I'm starting off by doing a covered call. And as I say, I decide I was going to put this here at the 64.50, and then I was going to buy a put for something, something less than this, 29.30 or 30. So let's just say I decided to do it at 20, buy it down here at the 20. It's jumping all around, but let's say I bought it there. Okay. So in this example here, because I'm collaring this off, the buying power went from $2,300, which was already really, really good because the notional value is $32,000, a little over that. But when we collar it off, look at this buying power that's required in this account. In your account, it might be less, it might be a little more than that, but it's still going to be very, very low amount based on what you are controlling. What you have to do with these options, with these collars on the micro futures or the futures contracts, you have to know the denominator, and then you have to do the math yourself, because this is only telling us here, you guys, it's only telling us what the extrinsic we're getting for the options part, which is about $55. Then it's telling us the buying power we're going to have once we have this whole trade on. Okay. But it's not telling us what our max profit potential is going to be, and it's not telling us what our max loss potential is. So the way you do that is that on the upside, you take this number, which is the 64.50, and you subtract this number from it, right? So let's just say that's 24, right? So 24 times 5 is 120. So that's how much you can make to the upside, is 120. Right? So not a lot. It's only $5 a point, and it's really close to where it's currently trading at, right? Now on the put side, what you would do is take this 655 and you subtract it from this number here. Okay. So I'm taking the 64.25 minus the 63.55. That's going to give me $70. So 70 times 5 is 350. So in this case, if you add the premium that we received, you're going to be able to make that 120 plus the premium, let's say, of $50. So equal 170. That's how much you can make to the upside. And if it goes down, you take this 350 minus the 50 for the credit you received. So that means you can lose 300 in this example, right? So you have the potential to make 170 in the next week and potential to lose 300. And so keep in mind, though, that this is the collar and this is the S&P 500, it's the index. It's not going to go to zero, but if it did drop 5% or whatever the case would be, where your losses should stop is at that 300. And then you should be able to slowly reduce that $300 loss based on how we teach this collar strategy. You do not have to realize losses. Now, I wanted to talk about a wide collar. This is not necessarily a wide collar. It's not a tight collar, but it's not necessarily a wide collar. So if we wanted to do a wide collar, what I would do is go something like this to the upside go to the 22 or tail ended expected move. I'm going to go to the 22 delta here. And then I'm going to buy a put for less than that. So you're going to have to go pretty wide on the put side to be able to buy something less than that. Right. So if I go way down here and I just say I went to the 14 delta there on the put side. So it's not giving me a huge amount of credit, but it's still a wide collar. Okay? And so if you did the math, you can know there's 75 points up. So 75 times 5 is 375 that you can make to the upside, plus your 13 cents of credit, I just say, of the premium that you're getting. So about 388 to the upside. And if we go to this put side here, all right, so you take the 64.24 minus the 62.90, and that's going to give us 134 times 5. So that's 660.70 minus the 13 in credit. That's going to be 657, I believe. All right, so 657 to the downside and 388 to the upside. So let me write that down for everyone to see. So we got 388 to the upside, and we got about 657, I think, to the downside that we can lose. Okay, and this is a wide collar. But the reason why you would do a wide collar on the MES is because it's the S&P 500, and you're going to be a core position into perpetuity with this. And so if you start off like this, this should be the worst case scenario. And then as the market moves, it just gets better and better for you.
So I
So how far is this from at the money? You can do the percentage amount, and that can tell you how far it has to drop before that put starts to help you. I'm going to answer your question 1 second. So we got the 62.90 minus the 64.25, the divided by the 64.25. And so it's that's 2.1% away. It's not a ton away, but it's 7 days to go. So that's how it is. So if it drops 5%, you stop losing that too. If it drops 3%, you stop losing that too.